Thanks for joining us, everyone. This is Dale Anderson. I'm the director at Fabrik Invest. I've worked in property investment now for near on 17 years. So I've been around the block. I was there during the recession in 2008, 2009. That's kind of when I got into property. And joining us today is Gary Das. Gary's passionate about marketing, entrepreneurship. He runs multiple businesses. He founded Active Finance in 2006. He's one of the UK's leading mortgage specialists. He's also found Active Success, so he does a lot of coaching, business mentoring. He runs the Pro podcast as well, which I've been listening to recently. Very insightful, so definitely worth giving that a listen. And in 2017, Gary also became an Amazon best-selling author. He wrote the book Self-Employed Mortgage Guide. So really great to have him on board with us today. Thanks for joining us, Gary. And yeah, I guess the big question is on everyone's minds: what's happening in the housing market today? Is the housing market in the UK, going to crash? We've got investors from all over the world, as I mentioned, UK, the Middle East, as far as Hong Kong, Asia, as well as South Africa, where I'm based in Cape Town, who are looking to take advantage of the UK property market. But also, obviously, there's investor jitters at the moment with what's happening with the uncertainty. So what the topic is today, the main subject is what should you do about your buy-to-let mortgage. Again, my name's Dale, director at Fabrik Invest. We run a team based in the UK. I've also got an office in Cape Town who do all the recommending of mortgages with Gary. And we also do recommending solicitors, managing the properties. We've got property investments from off-plan to HMOs, secondary apartments. So whatever you're looking for, we're there to help find and source the right property investments. So yeah, let's talk about interest rates. The Bank of England in the news and the budget, which we can say it seemed a bit of a disaster. There's inflation going up and obviously interest rates have gone up. But as I've said now for a couple of years, and those who have been into property for a long time will know that we have been in an environment of record low borrowing rates, which people have taken advantage of. It's driven the market. Property prices have grown. Even when the Bank of England said prices were going to drop 15% during COVID, the exact opposite has happened. And due to lack of supply, property prices have gone up. So the question we have today, Gary, what does this mean for investors? What are people going to do if they want to fund their next investment? Is cash going to be better? Are there still good mortgage options available? The benefits of different types of investing. Should they remortgage? I know I remortgaged on some properties recently. I got not too bad rates, about 4.5. Historically, I had rates of around 3%. So yeah, I'm going to give the floor to Gary for a quick introduction. He's going to run through a few slides just to update us on the interest rate market. And yeah, just sort of give us an update on what we should be doing, what we should be thinking of, and the questions we should be asking, and how we should be reassessing our property portfolios, investment portfolios, to hedge against inflation, and discuss what options are available. So I will hand over to you, Gary. Yeah, take it away.
Thanks, Dale, for your kind introduction. Much appreciated, my friend. Good afternoon, everybody. Could you just do me a favor and let me know that you are all still there? Could you put a 1 in the chat to let me know that you can hear me all fine and you can see me all fine and you're actually with it? Who's got a computer and a keyboard that they could put a 1 into the chat?
Hi, Ionis. Yes, welcome.
Have we got chat working?
Yep. One.
Oh, maybe I can't see the chat. Yeah. You can see the chat, but I can't see the chat.
Yes.
Okay, good.
That's
good.
Fine. So I can see them. They can hear us.
I was just thinking, Great. Then is everybody asleep? What's going on?
Yeah. Wake up. So
yeah. So to give you guys and girls some context before we kind of go to slides, I joined the industry in 2003. So at that time, the typical mortgage standard variable rate was around about 5%. I then carried on and sort of ended up going self-employed in 2006, specializing in bad credit. And in January 1st, 2009, we got smashed by the credit crunch. In 2011, 2012, interest rates began to plummet when they were predicted to go up. So interest rates have been predicted to go up for as long as 11 years. My first mortgage was 1.75%. I'm just coming to the end on my residential home of 1.75, and we've just refinanced to 4.13. So the interest rates that we've had have been all-time low. Now, this is my personal perception and personal perspective, but the reason why, you know, the interest rates are going up is because they're trying to curb inflation. But inflation is high because of the cost of living and also petrol prices. So it's not going to have the desired impact that's going to be needed. Now, will interest rates go back to sub 2%? Potentially not, in my opinion. But equally, in the next 12 months, if not before, we're going to be seeing lots of opportunity in and around property. And there's going to be some huge opportunities, which I'm sure Dale's going to share with you more, around buy-to-lets. Now, interest rates, as long as you are able to spend 4%, for example, and make 8%, you've doubled your return. So as long as you're getting cash flow, or as long as you're looking at capital adequacy and the property value going up over the longer period of time, the only principle that really matters is, does the deal stack up? And is that deal achieving what you want it to achieve? So just to give you a little bit of an overview, in case you are a non-experienced landlord, or this is going to be your first buy-to-let, or even just to break down, if you're experienced, some of the key aspects you need to consider with regard to buy-to-let. So as I mentioned, in 2003, is when I started. I started my own business in 2006, became a best-selling author in 2018 of the first guide helping self-employed people to buy and invest in property. And we also won Mortgage Strategies, which is like the Oscars of our industry's best small broker. The business has now expanded. We've done more than £1 billion in lending. We're a team of 24 based all over the UK. Specialist advisors. Some do buy-to-let, some focus on commercial, some focus on, you know, developments and land deals. Others do residential and self-employed. But collectively, we're a team with over 150 years experience in the industry. We've broken out now to not just be a mortgage brokerage, but looking at active insurance, active commercial, as well added to our kind of portfolio of product offering to, you know, to our prospective clients or existing clients. We're a company that believes in giving back. So we support a local charity here in Essex called the Rainbow Trust, where they support terminally ill children. So every application that we submit, we want to make sure that, you know, those families are looked after in such a tragic time. As a father of 3, soon to be 4, yes, I'm stupid and crazy. But as a father of soon to be 4 kids, you know, family's everything, family first. We do this property investment and this business stuff to build and leave a legacy for those that are going to be left behind, or at least that's my reason why, and that you may be yours too. So some key criteria that are going to be relevant as we go through this sort of buy-to-let mortgage side. You know, in an ideal world, you want a minimum of 15% deposit. You know, interest rates are looking at about 3.99% at the moment. 20% deposit, you're looking at around about sort of 3.24 on longer term fixed rates. In the good old days, 25% deposit, you would see interest rates being 2%. Now they're back up by the mid 3s and mid 4s as well. But the only thing that really matters when it comes to a buy-to-let is rental income. That's what dictates the amount of mortgage that you're going to get. Your income doesn't come into it at all from an affordability, calculating how much mortgage you can get point of view. So some lenders will have a minimum income requirement of 25,000, where there are still some available right now who don't have any minimum income. You know, particularly if you've left an employed job and you're living off some property income and you haven't done your first full year's accounts as yet, that would classify you in the eyes of a lender as to not having an income because you don't have 1 year's of property income. So even if you don't earn right now, if there are mortgage options available, but in an ideal world to fit more lenders, we're looking at a minimum 25,000 per year. If you own 4 or more, you get classified as a portfolio landlord, and the lenders will begin to look at your entire portfolio. They would want the whole portfolio generally to be below 75% of the entire portfolio's value, and not one property could be over that. So each property has to be below 75%. And you'll find at that level as well that some lenders limit you either to the total amount of borrowing that you can have with them or the number of properties that you can have with them. And this is why I always refer to mortgages being like a puzzle. And it's just our job as a brokerage, as an advisory firm, to take your square peg and make sure that it goes into a square hole, and not, when you go direct to a bank, a square peg ending up in a round hole, as I have experienced in the past as well. So generally we find from our investors, and we've got ones who are first-time buyers, you know, doing their first-time buy-to-let, shall we say, right the way through to our largest client who's got 96 properties, I think, currently, and really was sitting on cash waiting to scale up as well. You know, cash flow is kind of king from many of their perspectives. They're not looking at capital adequacy, but we've got the other guys who are building a portfolio, want to pay the mortgages off, leaving a legacy for their family and significant others, so that, you know, money's not going to be an issue. So I'm always interested, from speaking to thousands of investors, you know, what's the end goal that you're looking for? Once you're clear on that, it helps you to devise the strategy that you want to follow. If you're buying property with a view to refurb, refinance, buy, refurb, refinance, BRR, as it sometimes gets condensed down to, then it's worth knowing that there is a 6-month rule in place. And that's if you buy the property today and then you refurb the property, generally, most lenders, up until the point of 6 months, will use the original purchase price of that property, even if you added £100,000 worth of value. So if you buy the property today and refurb it, if you can keep it for 6 months, in 6 months' time, they would generally use the increased value of the property. And that also goes for the same as if you buy below market value. You know, if you buy something today and you get it for 30, 40, 50 grand less than it's actually potentially worth for, you know, a motivated seller or whatever it might well be, you would need to potentially wait 6 months in order to be able to utilize the higher figure for remortgage purposes. So how much can you borrow? Well, the stress test is key. So rental mortgage coverage has to cover the mortgage payment on an interest-only basis by 145%. Now, typically, pre this economic time, lenders would calculate that interest-only mortgage payment on a 5.5% interest rate, typically. If you were looking at short-term lets like serviced accommodation or Airbnb or holiday lets or anything like that, then there are lenders who could take an average of 30 weeks rental income, because that's a way in which you can really maximize the value of that asset. You know, you're getting paid on the high season, the low season, or the medium season. They're taking an average of 30 weeks. You're getting income per night, maybe £75 per night rather than your £750 per month. So that could enable you to borrow more. But sadly, at the moment, most sort of short-term lenders are doing what they do in typical buy-to-let world, which is use whatever figure is on the AST, the monthly tenancy agreement. So grab your phone as we speak, because you're going to want to take a picture of this next slide, because this is how you can calculate your stress test. So if you're looking for £100,000 mortgage, and I'll do it on my calculator with you so you can see, £100,000, we multiply that by 5.5 and press our percent key. Now that gives us an annual interest-only mortgage amount of £5,500. If we now divide that by 12, that means our monthly interest-only mortgage payment is £458.33. So if we now multiply that figure by 1.45, we would need a rental income of £664.58. So call it £665 for every £100,000 that you could borrow. Now, what's happened sadly at the moment, which I believe will change, can't put a time on it because of the crystal ball moment, but that 5.5% that you can see there with some lenders is 7.5%, with other lenders is 8.5%. So for the same £100,000, what's happening at the moment is you're looking at 8,500 annual rent, which instead of 665 is 1,027. So it is a significant need to get more rental income for the same value of mortgage. which means that you'll have to put more deposit in because you can't borrow as much, but that's all going to be coming back. And that's why I always talk about finance first, because when you know where you are and you're going out viewing properties, it enables you to really get to grips with how much you can borrow and to find the right deal for you. So regulated or unregulated, a regulated loan, if you're looking at letting your current property to buy a new property, anything that's regulated is in a home that you have lived in past, present, or future. It could be a relative as well, whereas most buy-to-lets that are bought for investment purposes are unregulated. And that just means that, you have more flexibility around the affordability. You have the option to potentially borrow more. And it's just about making sure that you get the right mortgage based on the circumstances that you need to go forward. A few things to be mindful of: how much you can ultimately borrow. How much does it actually cost to get your buy-to-let mortgage? Generally lenders will charge an arrangement fee, and that is added to the mortgage. It's deducted on completion, or it can be paid up front, and that's dependent on the lender. Worst case scenario I've seen at the moment is one particular lender who has positioned themselves as if nobody else will do this deal, we will, but we're going to charge you 5.5% and we're going to charge you 3% of the loan. Crazy how they're doing it, but they're literally positioning themselves right at the very back. Someone's got to be, dare I say, not desperate to purchase it, but it's got to be an extremely good deal to make that worthwhile, And there will be people who will go for that product because the deal will make money. And that's the key thing, is the deal going to make money? If you can buy it now and refinance in 2-3 years when the market, fingers crossed, improves, you're going to be even better off at that point in time. Guaranteeing that you'll stay with the lender for a period of time will give you an early repayment fee. So if you were to come out of the deal early, they will charge you a penalty to do so. So if you commit to a 2, a 3, a 5-year fixed, the recommendation is to stick with them for that period of time, because, you have to calculate any lost earnings off of the back of that. You'll have other fees such as valuations, admins, broker fees, potentially supplementary charges by the solicitor. But most lenders calculate interest on a daily rate. So if you pay £10,000 off the mortgage today, tomorrow you're not paying interest on that. So typically they'll allow you to overpay by up to 10%, which reduces the amount of interest that you're going to pay, which in turn means that you're effectively reducing the mortgage payment, or potentially reducing the capital of the loan and keeping the payment the same, whichever you would choose. So that's a brief overview of mortgages. The way in which we work is we work on a very structured process that gets results. So we call it a strategy call, working out where you are versus where you want to be. That's our first appointment, shall we say. We then go into getting your documents from you in order to be able to assess your affordability and assess your ability to get the loan. We go through all your personal information. That enables us then to do step number 4, which is assess the criteria and assess the market research and come back to you with the best possible terms for your situation. So we do all the leg run, running up and down and finding you the best deal. And we're obligated. It's a regulation and a rule that we have to recommend the lowest, most cost-effective mortgage for your circumstances. Long gone are the day of the dodgy mortgage advisor who would pick a lender based on the amount of money that they were going to receive. From an integrity point of view, I've never done that, but it's got rid of the chaff from the industry, shall we say. But we've just always want to make sure that you get the best deal, because as I say, we've got people with us who started with 10 properties and now have, 50 or 60. But once the mortgage has been agreed and the application's in, property gets valued, formal offers agreed, the legals take place, and you get your victory. And then from there on in, we do a lot of restructuring of portfolios and helping clients to move, transfer their mortgages from personal name into limited companies and refinancing those properties and all of that jazz. So we're all self-employed, because then it enables us to help you understand and be entrepreneurial with property thereafter. As I mentioned at the beginning, and Dale kindly said, I did write an Amazon best-selling book. Both got bestseller in 2017 in the written version, and then the audio book in 2020, I think it was 2019, 2020. You can grab that on Amazon. Alternatively, if you do have your phone still with you and you grab the camera, if you hold your camera over that code, the QR code in the bottom right-hand corner, then what it will do is it will take you to a landing page where all we ask for is your name, number, and email address, and it will immediately send you a PDF copy of the book. On the second page, after you've actually downloaded the book, rather than paying Amazon $12.99, all we do is ask you to pay the postage, which is £4, and we will send you a physical free copy of the book. So you get a full copy from my team directly, and you get it for £4 rather than $12.99 off of Amazon. If you can't get the QR code to work with your phone, then it's very simply www.theself-employedmortgageguide.co.uk. So hopefully that's given you some key insights. Just as an idea, around about 24 pages of the book specifically relate to self-employed income. The rest of the book is all the foundational, very things that have never changed, in the industry: deposits, buy-to-lets, criteria, everything you need to know about purchasing finance to help you think finance first and get the best deal. Thanks very much indeed, Dale.
Wow, brilliant. Thanks, Gary. I mean, that's some really good information in there, guys. We've been on the webinar for a few minutes. You got yourself a free best-selling book. Obviously, we'll drop it in the comments later and gladly send you the link to Gary's company, and also the link to the book, which I'd highly recommend you take advantage of and read. So a couple of questions, Gary, just while we're on the subject of mortgages. I mean, what, in your opinion, what do you think is going to happen to the property market in the next year or so? And, I always say property is a mid to long-term strategy, really. It's not speculative, it's not short-term, and I've always stuck to that. But what are your thoughts on the property market? You're in the UK. I'm watching everything going on in the news, and a lot of it can come across quite negative. So what are your thoughts?
Yeah, I think there's going to be opportunities. Certainly in the next couple of years. I think there's been predicted there's going to be a crash. If you look at the property cycles, there's always a dip in property prices, and there's going to be opportunity around. I think one thing that's being underestimated that I talk about a lot, what most property investors don't realize, is that next year, 2023, there is the largest number of people coming to the end of deal periods than ever seen before in history. So there's 5.5 million mortgages coming to the end of some kind of fixed rate or something like that. Now, what that's going to mean is that they're coming off of low sub 2% interest rates, and all of a sudden their interest rate's going to double. That's either going to be an accidental landlord who now is not only got their personal income completely screwed because all the rental income is going against them personally, and they're not benefiting from buying in a limited company SPV. But now, as an accidental landlord, their payments going up massively. So their profit from their property is no there. And there's going to be accidental landlords who decide to offload. There's going to be big portfolios that decide to offload. The unfortunate thing is so many people have lived to the maximum of their personal affordability on their residential homes that now are not going to be able to afford a mortgage. For example, my payment went up £600 as a result of going from 1.75 to 4.13. Now, fortunately, I can afford that. But what I actually chose to do, because I'm at 50-50 in terms of equity in my property, I don't want 50% of my property sitting there doing nothing from a cash perspective. So I actually switched to interest only, because the £600 saving is better off in my business, because I'll get a much higher return off of that money. Sure. Now, a lot of people don't have that luxury. So a lot of residential people are now going to be looking at increased payments, increased petrol, increased energy bills. And I think there's going to be lots of repossessions and stuff coming as well, which I think will also be a negative for many of those people, but a positive for the market, in the fact that that will force interest rates to be reviewed. And as inflation does go, start to come down, then interest rates will start to steady out. And I think we'll probably end up at around 3%-ish again. I don't think we'll go back to where we were, but I think there's going to be lots of property opportunity on the horizon.
Great. Yeah, so I'm just going to share screen quickly, and that's actually on this topic. Just bear with me. Share screen. So yeah, this shows the interest rate graph. Yeah, and as you can see, sort of just before the recession, 2008, 2009, that's when I really started getting into property and realized what a great investment it was, because of the recession and because of the irresponsible lending all the way from the USA. There wasn't a great deal of regulation on the type of lending that was being done. So this is what caused the crash. And, we saw Lloyd's Bank had to be bailed out, Royal Bank of Scotland. But after that, we've had this combination of recession, low interest rates, not as much lending available. So cash was really king during those times. And then what I noticed then, obviously with Brexit, we had Brexit. So again, the bank will be, okay, we're going to keep interest rates low. Followed by COVID. Okay, we're going to keep interest rates low and do stamp duty holidays. So a lot of people did really well. They fixed their mortgages. Well, what does it mean for people looking to their current mortgages? If they're coming to an end, so they switch to a fixed rate mortgage, so they look at variable. What would you recommend? Sorry, just unmute.
It's I'm always worried about a child running in. That's the reason why I just keep in case of that.
I've got twins myself. They're four years old now, 4.5. So I totally understand.
Yeah, just to play safe.
Tell the wife to keep them away, but yeah, that's fine. No worries. Carry on.
Yeah, I think it's very personalized to your individual circumstances. That's the real thing. As I say, from the discounted rates, what we saw years ago was, you would say, for example, rates meaning nothing. A discounted or a tracker rate would be 3%. And then the fixed rates would end up being something like 4%. So there was always a distance between fixed and variable tracker discounted rates. What we've seen over the last couple of years is those have kind of almost come together and have been very similar. Now, once again, we're starting to see the distance between, I've got a little bit more risk appetite in the discounted and the tracker, and I want more safety and security in the fixed. So really it depends on your preferred risk appetite, whether whether you are going to bargain on interest rates going down or whether you think they're going to continue to rise. I think they're going to continue to rise for a period of time, and then I think we'll see a little bit of a steady drop. But it is crystal ball moment, and I think you just need to look at buying for investment. Fixed rates will give you security and therefore guarantee your cash flow, whereas a discount will probably give you more cash flow in the short term, but you will have peaks or troughs like you see on that graph where you'll either win or you'll lose.
Yeah, totally. So, I mean, I've got property. I managed to fix the rate for the next 2 years. I don't need to worry. However, obviously, after 2 years, we need to look at what's going to happen. So it all depends on the deal, like you say. There's a few key principles we'll look at. Is are the sellers of the property motivated? So we are in times of uncertainty. There are going to be motivated sellers. There are going to be people planning on retiring. They've done well with their property and they want to dispose their assets. And what that might mean is there's actually less landlords and less rental property available. So for me, that's going to put rentals up. So I'm already seeing reevaluations on some of our portfolios where the rental properties in Manchester, for example, are renting 15% higher than last year. So a lot of that's actually counteracting on the increase in interest rates. So again, you just need to look, is it a motivated seller? You could be looking at getting good deals at the moment because of what's happening in the market. Developers, sellers are motivated. Are they flexible on price? Or can you get a better deal now? So in crisis comes opportunity if you're smart and you look at the right deals and get the right education. Number two, strong rental demand, because ultimately the great thing about property, it doesn't matter what's going on in the market with interest rates. Is there a tenant in? Is the tenant covering your debt? We talk about Robert Kiyosaki and the cash flow quadrant. Is it cash flow positive? So you want to look at your rent. Is it covering your mortgage? If it's not, and you're in negative rental or negative equity, then you might want to think of selling. Number three, as I mentioned, cash flow positive. Cash is king. The more money you can put into a deal now, probably the better. The less you can expose yourself to debt. So if you've got liquidity or you've got funds spare, it could be a good time to take advantage of these deals. And number four, again, property is mid to long term. So you've got mid to long term growth in the UK. Even if prices go down, like they're saying they're going to go down next year, Savills are saying maybe 4% down or 5%. If you bought 2-3 years ago and you plan to hold the property, prices will gradually go up. So do you think that interest rate only mortgages, I mean, that could be quite a risky strategy, I guess, depending on the crystal ball, like you say. So fixed rate might be a better solution unless we think interest rates might go down, I guess. What are your thoughts?
Yeah, I think interest rates. So I would have gone for I would have gone for a 3-year if I could have got one, but I ended up having to go for a 2-year. Because I'm taking the mindset that the 2-year was low enough that I think within 2 years, they'll be kind of on the way back down. And if we see what happens then, it's going to be very interesting as to where it goes. As you see there, the base rate was obviously way up in the 5s.
Correct. Yeah.
Where's it going to end up? Will it go that high again? I honestly don't believe, with how affordability has been, that it can actually afford to go that high again. Yeah. The conversations that I've been having, like particularly with commercial lending with the likes of Investec or Coutts or Barclays, they're sitting on more cash reserves right now than they ever have. So they're really cashing in at the present time in any way, with interest rates being where they are. If they've got more cash reserves, then you would think they would be more willing to lend, but that's a challenging one. So it's very uncertain times, but
okay, great. So just assess your portfolio, look at the rents. I mean, as I said, rents are going up, and consider the rates, how much they may go up. I don't think we're anywhere what happened in 2009. I think banks have become more regulated with lending, so they do need to control things. And fighting inflation, can investing make your money work harder for you? So the next slide, we'll move on to the next slide. The issue of inflation, as we mentioned, uncertainty tends to make investors a bit jittery, but due to current inflation environments, holding cash in savings can actually reduce the power of your cash. So what's happened now? The Bank of England are printing more money, quantitative easing, and the pound has subsequently dropped. I think it was 1.10, 1.15 to the dollar. We've actually got a lot of overseas buyers, and we've done some numbers, and they're saving money as well because of the currency movements. So it's certainly of concern. I mean, I saw the news today, food, oil, petrol, and this isn't just the UK, by the way. This is all over the world. And they're saying it's the war in Ukraine and it's this and that, but I think it's down to politics, economics, banking, and the crisis in supply of material and food and things. The world is a growing population, so it's natural that things will go up and go down. So in terms of the inflation situation, I think it's around 10%. The highest has been in the UK for 40 years. Someone holding £100,000 in saving would potentially lose 10k a year just on the currency alone. Plus, with inflation, to stay over 5%, keeping money in the bank may not be an attractive option. So a lot of people have money in the bank and they think, what do I do? Do I hang on to it? Do I invest it? And where do I invest? So just as an example, rental inflation has actually gone up quite significantly as well. I was looking at something about Manchester earlier, and we have full occupancy on our buildings. Rental prices have gone up 20%. So not only is food going up, but rental going up. It's not great. It's not nice for people sort of on middle income, of course, with rents going up. But for landlords, I guess it can benefit them as well. And there's a lack of supply of rentals. I think this will be further fueled by less landlords in the markets because of everything going on. So this dynamic could be compounded. There's less supply of built-to-rent homes, and rentals in major cities like Birmingham and Manchester are actually going up. So what does this mean for investors? I just wanted to discuss different types of investments. So I like to diversify. I've always been a big believer, don't put all your eggs in one basket, and you want vertical income streams. And I did invest in Bitcoin. I don't know Bitcoin like I know property. I invested when it was at a peak, probably around there. So I've lost on my Bitcoin portfolio in value. Probably it's gone down 30-40%. Ethereum as well. And this is the FTSE, the NASDAQ against property prices since October. So where do you invest your money right now? You've got cryptocurrency, you've got property. These are unstable. They don't give you a passive income, and they can go up and down. So with everything else going on, the crypto market's also in turmoil, as well as the stock markets. Do you have any other investments, Gary? Do you invest in crypto or anything like that, or?
I started to and then lost it. So I think I put about 5 grand in, and I'm at about 1,500 quid at the moment. For me, like you said at the beginning, I love business. I love marketing. I love sales. And that's really controlling the controllables for me. So I've been buying or building other businesses, and now I'm in the process of buying other businesses and folding them into the existing empire. So that for me is what I'm holding out for is, and I have been holding out for some time, is I want to get into some commercial property. So I want to buy a commercial for my business, have the trading business in there, but then buy something bigger than I need and let out some rooms and stuff like that. But also then begin to buy up some additional properties when the market does crash. So I've just been sitting waiting really and investing in the business for the last 4 or 5 years, but that's going to be my strategy. Gotcha.
Well, that's interesting. Anyone on obviously put in the chat if you have invested in crypto. Would love to know. And also if against any other investments, if you've invested in Ethereum or stocks, versus your property, what's done well and what's not done well. We're always keen to look into that. But as you can see from this graph, property is kind of stable, it's tangible, it gives you an income. The other option's gold. I mean, gold's a great investment, don't get me wrong, but it's a long-term hold, commodities, silver. And again, it's that one crucial thing, it's not giving you passive income. And a lot of people we work with, they're planning for retirement. They want to get to a position where they don't have to work anymore. I'm tired of working. I want to enjoy my life. I want financial stability for my family to leave a legacy. So, for me, I've dabbled in many things, and my property that I bought 8-9 years ago, I paid like £200,000 for some apartments in South London near Croydon. It's still valued at 300,000. Even if it drops by 10 or 15,000, I'm not bothered. I'm still up 280. I get £1,100 a month. My mortgage is currently £500. Even if that goes up, I'm on £700. So cash flow positive, it looks after itself. And I hold on mid to long term. So as long as you can hold on to the property, I think that's key. If you can't afford to hold on to property and you're in a cash type position, then you may want to consider what your options are. So we're going to go on to the resilience of the UK property markets, because I've been here before. Brexit, people were worried and scared. Recession, people were worried. And I've always said, look at it sort of as a 5-year investment term. We know the UK market has a proven track record. It's one of the fastest recovering property markets in the world after 2008. Why? Because of the limited amounts of land to build on, the lack of supply of housing, and the shortage of rental accommodation. There's long-term economic and political stability. It may not seem like that now, but compared to markets like where I am in South Africa, where you've got load shedding, they turn the lights off, you won't believe it, like 2 hours a day, they turn the electricity off. Our interest rates have gone up to 9%. So I'm paying around 9% interest on my house in South Africa. So there are other markets which are subject to their own problems, and they do still view the UK as a great place to study, great place to live. So yeah, there's an opportunity for rentals, occupancy rates and rents are high, and there is increases in rents over time. According to JLL, UK is home to the world's most transparent property market. It's also got a significant amount of securities in place, unlike some of your European markets or some of your emerging markets, which are less secure in terms of the legalities. So this is just a graph I thought I'd show you guys on property investment. Anyone who bought in the 90s, I mean, they've done really well. They were buying properties. When you speak to your parents and things like that, buying houses for £50,000 that are now valued at average £250,000 to £300,000. So as you can see, historically, even during the dip, slight dip, 2008, markets are in turmoil, and there the UK market you can see going up gradually again. And this is where it's expected to go by 2025. So why is the UK market great? We believe, obviously, with interest rates rising, people are paying greater attention to their portfolio. There's obviously a good reason for that. The UK does have a high demand to supply ratio, and you can get better yields on stuff like short-term rentals, like you mentioned, serviced accommodation, long-term hold. You've got capital gains. Plus, there's an opportunity to leverage equity. So a lot of people have bought in London and they release equity to buy in places like Manchester or Liverpool, where they can effectively release money and invest cash as well without having any debt. So that's one thing to consider. So we do a lot of market research. We look at Mark Frank, Savills, Zoopla. Zoopla house values have increased 8.2%, they're saying, in the last year. Obviously, that may stabilize now or slightly come down, I believe. But the average value of UK property is currently sitting at £286,000. The demand for property continues to drive values and rents, as I mentioned earlier. In terms of the rental market, we've seen a 12% increase in rentals across the UK in Q3 2022. So there's still chronic undersupply of good quality rental homes, which shows no sign of changing. As sort of life returns to normal, we can look at different strategies as well. So the asset classes that we look at are, a range of different assets from off-plan. You've got HMOs, you've got rent-to-rent strategies we can discuss. We do secondary stock all the way up in towns like Blackpool, where we can get BMV or below market value deals. And I do believe there will be secondary properties coming to the market, potentially with motivated sellers distress. So there's different strategies. Agree with you, Gary. It's best to get on a call and come up based on your personal circumstances on the right strategy for you, depending on your personal circumstances and what you're looking to achieve. So just again on the rents are outperforming capital gains. There's this low supply and competition for listings. Rents have climbed across all regions over the last 5 years. The average amount of rent stock has almost halved. So what we're finding, there's a lot less new build actually coming to the market because of inflation. So a lot of developers like, whoa, build costs, it's not making much sense. It's very hard to find the right deals. And that means there's actually less supply coming to the market, lower voids, and higher demand for generation rents, who now, probably with interest rates going up, have an even bigger problem of affordability. So your younger generation will have no choice but to either rent, and they'll probably look at compact living in the cities, such as studios, 1 or 2 bedroom apartments. So those are our thoughts. We want to look at alternative assets. So I just wanted to go into a market where investors done really well, but then COVID hit, and it was a bit of an issue because all of a sudden student accommodation, right? Everyone was staying from home. So the universities sat empty. So all of a sudden PBSA was not very popular. But what I'm seeing now is there's some real estate investment trusts, again, buying wholesale blocks of student accommodation in the UK because things are returning to normal. You've got one of the biggest student populations in the world, some of the best universities considered in the world, and 2.6 million students. So again, this is an asset class I think is worth looking at because it is recession proof. It's a passive income generating asset. There are many students renting out purpose-built accommodation. And the main goal there is passive income and low entries. So you can buy student properties anywhere from sort of 70,000 up to the 130,000 for your standard studio, for example, to your bigger HMO deals, which can be very profitable, I believe, in the current market. And the great thing about these, they are fully managed for investor ease. A lot of our investors, they don't want the hassle. They are professionals, or they work or run businesses or planning for retirement. It's an evergreen asset class. There's been growing demand for years. They come fully furnished, and in some cases, there's 0% stamp duty on those. So that's something we're going to be looking at in the future, and we'll be launching some student accommodation properties. What's happening in the off-plan market? We are seeing developers now offer some slightly better deals. So we're seeing a better option of incentives. So they're throwing in free furniture. They're going to start, being creative with the deals. So you might actually find that you're getting a better selection of properties. Again, and this is something I'd like to discuss, is 20% down on most of our schemes. So some of our developments complete, so they're part of big regenerations like Liverpool Waters. There's 20% down, balance at completion 24, 25. So you don't actually have to worry about your mortgage until then. You might want to fix in your currency, but again, that's something. On that, Gary, with the off-plan investments, how would they go about with their mortgage process and application on something, say, that's going to complete in 2-3 years?
So generally what you would do is depends on the new build developer, but normally what you would find is you'd get an agreement in principle at the very least, because that's a kind of credit check as to where you are now. There is an element of risk with that, and we always advise people that if it's going to complete in 2 years, if it's for investment purposes, most lenders do a soft search, but just make sure you keep your credit history clean for that period of time, because the last thing you want to happen is go and miss a payment on something, and then you get an interest rate that's 0.5% higher, or worst case scenario, you can't get an interest rate at all. So it's okay to do it. We have lots of clients who do it. Just make sure that you protect your credit score like an absolute piece of gold dust.
Yeah, because people's circumstances can change, right? With work, income. So you can assess and give a pre-approval, but it's important that we securitize or make sure that the client's credit and everything else checks out at the point of completion. However, at that point, interest rates, I believe, may have come down. We're not quite sure, but that's something to consider, because you only need 20% now, and then you lock in the property, and then you take out equity once it's built. And the benefit with new build is the EPC, the energy rating, so the running costs are lower. You get a new build warranty that covers like damages and anything else. It's a good sort of fully managed option, I guess, for portfolio diversification. And again, we focus on areas near business districts, Media City, Liverpool Waters, places like that, which have an extremely high demand and a lot of regeneration going on in those areas. Just on the rents track, so this is something that we were researching recently, talking about rents. So the rents, due to low supply, competition for listings for multiple tenants have increased. We're seeing rents climb across the UK. The number of available homes to let is lower than the long-term average, and the average void periods are a lot lower as well. So tenants are getting in quite quickly. That's why we tend to focus on the main towns and cities like Liverpool, Manchester, Birmingham, because we know they've got the population and they've got the demand. So these types of strategies can work quite well. So continued growth in students, and then off-plan for professionals, young professionals, we believe are good because of the rental inflation. I just wanted to go through very quickly a few examples of current projects we offer, which you can sort of look at hedging against inflation. They offer rental assurances, for example. So we've got a purpose-built accommodation in Manchester called Cheltenham Place. Manchester's got over 104,000 students, 5 universities. This is walking distance to Salford University, and it's a 5 to 10 minute commute into the city centre and the University of Manchester. What I like about these, they dual purpose. So you can rent to young professionals or students, and we will look at things with due diligence and off plan. We look at developer funding, we look at track record, we make sure they've delivered a good volume of developments in the past. We're not working with developers where they're stuck with their first project or their second project, because it can be a risk, right? So there's a lot of due diligence we do. This is by X1 Developments, who pay rental assurances. So they'll pay ring fence investment of the 7% net assured rents for 10 years. So that's 7% net of income tax, and that's fully managed. So that's a great hedge, because you kind of know what you're getting, right? It's 124,000, you're getting a 7% net yield, and you can work that out against your costs. We also believe in Birmingham, because they're building the new high-speed rail. Solihull, lovely place. It's part of Birmingham City, but just outside. And that's going to be the first stop on the high-speed rail, which will be delivered, I believe the first station, Curzon Street, around 2028-29. So that will cut your commute time down into the city centre of London. And all of a sudden, this town will become a commutable town. It's got a lot of green space. It's going to benefit from all this regeneration, and it's ranked one of the top places to live outside of London. So again, on those, you can do 2 strategies. You've got a 5% rental yield on a long-term rental, or if you do short-term lets, we use a company called My Property Host, based on their forecast, which they get from AirDNA, which gives you all the data on short-term lets, corporate lets. You can get up to 8% net yield, which makes it definitely cash flow positive. That's under construction, completing in July next year, so it's well underway. and that will benefit from the HS2. We've then got a couple of new ones coming. So we're just about to launch phase 2. It's actually the final phase right on the waterfront in Liverpool, and it forms part of the wider Liverpool Waters regeneration. So that's £5 billion being invested by the Peel Group, who were responsible for the Media City, which is like the Canary Wharf of the North. So they've developed, we've seen prices go up in Salford Media City by about 30-40% in 5 years. And all of it's now all this investment's now going towards Liverpool Waters. And this is one of the first phases of a new waterfront development, very high spec, lots of facilities. They're building commercial offices. There's Greenland and a park next door, which they're going to be renovating. And then, of course, a new Everton stadium for the football fans. So Liverpool's been very popular, and we're just about to launch. Phase 1 sold out in literally 4 or 5 weeks, but our investors will get early options on this particular product, which will email them in the next, they're probably going to receive an email tomorrow on this particular development with first choice of the apartments in the new block. So that's one to look out for. Not only that, we've got one coming up, Platinum Towers, which will be the tallest residential tower in the Media City, which is near BBC headquarters, RTV. So it's going to be 40 floors, high-spec apartments with concierge, gym, residence lounge, and also co-living, co-working spaces for your remote workers or hybrid workers. So that's the kind of trends we're seeing. And again, they do offer a rental assurance on those particular units at 6% for the first 5 years. That will be delivered probably around end of 24, early 25. So that's coming soon, and anyone interested, we'll send them details and arrange a consultation. Not only do we do off-plan, we have a division of our company who are experts in lease option agreements. They have secondary stock available. We've got, for example, service completed apartments in Blackpool, which is a famous tourist area. So it's completed. There's no off-plan risk. You'll start to generate 6-7% income through a FRI lease, which is pretty much the fixed lease agreement at 7% fixed, and they don't have to worry about any of the ongoing costs. Again, ideal for long and short-term lets. So we can take the hard work out of sourcing. If you don't see on our website what you want, or you just give us a call, tell us what you're looking for, and we've got a sourcing team that can find below market value deals. So what we look for is, number one, regular source of income on rentals. Number two, capital growth. Are these areas going to have growth? Maybe not in the short term, but mid to long term because of regeneration. Number three, recession proof. UK property does tend to be resilient. UK buy to let recovered its value just 2 years after 2008. So it was a 2-year slight dip. Prices went back to normal. Number four, high demand. So we look for areas where there's a high rental demand and tenant pool. And number five, guard against inflation. We look at property prices. Are they the right market value? Can we get some sort of a discount for our clients? And then, is there going to be a case for them to help offset some of the increased costs by looking at increasing rents on the property as well? So just wanted to give a quick overview on that. And then also for our overseas buyers, very interesting. So I did a exercise last week. We've got clients from the Middle East, Hong Kong, wondering whether it's a good time to buy. So if they bought with us back in October 2021, the price of an apartment in Birmingham, for example, at City Green, £185,000. USD would have been $255,000, and they are currently buying at $204,000 on the currency rate. So they're saving up to 20% off the property price. So even if prices go down by 5 or 10%, they're still in the same position they've actually saved on the currency. Same for Hong Kong and dirhams for Middle East buyers as well. So that's something I did last week. Unfortunately for us in South Africa, there's only 4% saving because of everything going on here. The currency has also dropped. So that's an interesting point on the currency markets. And then just finally, Fabrik Invest is a trusted provider. We want to make sure things are safe and reliable. You can go check us out on Trustpilot. We also do, our purpose is to, help people create financial stability. We work with a children's charity called the Crystal Kingdom. So Paul, he's one of our partners. He's busy working on a property affiliate program for us, which we're very excited to launch, because it means anyone buying property with us, you don't just have to buy property with us, you can make money through our affiliate program just by referring clients our way. But yeah, that's what we do. So we do a lot of research. We'll make sure you make the right informed decision by providing the right education, and then you can look at what's available and what type of properties we can offer. So yeah, that's it from me. Next steps, just request a brochure. If you put in the chat any of those properties that you've seen, if it's Manchester, put Manchester. If it's Liverpool that you want, put in Liverpool. If it's Birmingham, drop in Birmingham in the chat. Or if it's student accommodation, just put students in the chat. If it's secondary property and you're looking for a bit of a deal on a secondary unit, or a lease agreement of some sort, those types of deals, just put in secondary into the chat. So thanks for having us. Thanks, Gary, for obviously joining us today. I'm going to hand it over to the audience for any questions, if they've got any quick questions to put into the chat. And then, yeah, we'll see what comes up and I will ask the questions. So let's see what we've got. Ionis has asked, what are interest-only mortgages? So this is one of our overseas clients. So he just wants to understand interest-only mortgages. Just unmute. Kids are coming there. Ask to unmute. There we go.
There we go.
There we go. Thanks.
One of them came running in going, Dad, your dinner's ready. I'm like, you'll have to wait.
Fair enough.
So generally, there's two types of ways in which you can repay a mortgage. So you have a repayment mortgage, which means that over the course of, say, 10, 15, 20, 25 years, your loan starts up here, but by the end of it, it goes down on a sliding scale and it ends up at zero. Now, most of the interest on a loan is paid up front. So the shorter the term, the less interest you pay. And the further you are into that loan, the less interest there is going to be on the payments. The alternative, which most investors will do, particularly if they're going for cash flow, is go for an interest-only mortgage, which means you don't repay any of the capital. You just pay monthly interest based on the amount that you borrow. So if you borrow 100 grand today, in 25 years, you still owe the bank or the lender 100 grand.
Correct. I know a lot of buy-to-let landlords do this because they can get the income without paying the capital, but at a later stage, they can repay the capital as and when they have the resources, right? So maybe they're getting a Christmas bonus or salary increase. So as you go, you just repay the capital. And it works quite well because it does reduce your repayments, especially now when interest rates have gone up. So that's something to consider. Another question that we've got coming in is, quick question, Gary, when is a good time to buy a property in the near future? Should we wait till 2023? When in 2023? Or go ahead and try to get a property before 2023? I know no one knows what the future will bring, but what are our expectations?
Yeah, it's probably a better question for you, to be honest, Dale, because the thing with that is, I can't predict what's going to happen with interest rates. I said to people, if the deal stacks up now and you can make good money out of it now, then the opportunity is going to be there in the future to potentially save even more on it. So it's all about the deal that's presented in front of you from a mortgage perspective. Our job is to make sure you find the cheapest finance. Someone like Dale will advise you on whether that property is a good purchase, for example.
So I mean, we would look at the numbers. So the first thing we'd want to do is understand, what type of investor are you? We will deep dive into your current financial situation, how much funds you're looking to invest. You get different types of investors. You get people that are funders. They just want to put the money into the deal and not worry about it. You've then got other people who are, looking to cash fund investments and just get a passive income. And then you've got people looking for, sourcing. So connecting deals with other deal buyers, people who want to invest. So there's different types of investors we can look at. But what you want is to be getting the right advice from the right professionals. So we can put you in touch with, all our consultants have minimum 10 years property experience. Many of them have invested in properties. Between us, we've got a portfolio of over 50 properties. We've made mistakes. You know, we've learned through making those mistakes. So just book a consultation. It's not going to cost you anything. We'll actually come up with a free personalized strategy report that suits your particular requirements. So that would be my answer. There's never a good or bad time. I believe when there's crisis, it could be a good time to look for good deals. And right now could be that time. So yeah, that's my thoughts on that. So yeah, any other questions? So there's another question. It'd be good to see cash flow positive examples. They'll any one of the displayed today be cash flow positive. So yeah, I mean, I was looking at a deal that we have. I'll tell you what, I'll share screen. This is the Liverpool deal that we're busy working on. So just bear with me. So this is a one-bedroom apartment at Liverpool Waters, which we're just about to launch the second phase, which is right on the waterfront. So £157,000 market price. That's good value for money in Liverpool. I've done a lot of research on the comparables. You put 25% into the deal, less the 2,500 res fee and a 500 admin fee. This would be your mortgage repayment. And then you've got your stamp duty land tax to consider. We like to look at things worst case, so we'll show you what all the buying costs and additional fees and the mortgage broker fees as well. So your rental on those this is based on a 75% loan to value mortgage. We're looking at £880 per month. That's £10,500 income per year. Now, mortgage at 3.5, you're looking at 4,259. And you talk about that sort of stress test and, you know, checking the rate. So we could increase that, say, to, that's actually 4% that I've got that in. So at 4% interest, you're looking at 4,295. Service charge, management's lettings, that's to look after, find tenants, credit check, all those things. Service charges for upkeep of the property. You still got a cash flow positive net rental return per month of £416, which is £4,988. And your mortgage has been covered by your tenant. So for me, number one rule is my tenant covering my debt. That's for me important. If not, can I afford the additional repayments? Is it worth it? And then we look at the capital growth. You know, we're assuming based on Savills and JLL, they still project prices in places like Liverpool City, Manchester will go up around 20% over 5 years. We've seen them go up 30, 40% in the last 5 years. So say, for example, market price 157 worst case scenario plus 46,000 uplift, you're looking at a potential 157% return. There's not many places you can get that. Obviously, that depends on market and if rents go up or down. So as an example, we can definitely send you some financial information on that. So that's it from me. Is there any other questions coming in? I'll just double check. I think there's a few more coming in. Just bear with me. My refinance on my property is due. I want to take money out, but struggling to get a mortgage. Any suggestions? I think that's one for you, Kerry.
So it's going to depend on the reasons why you're struggling to get a mortgage. And that's where I think if you want to book a call with obviously the team, then we'll be able to, without a shadow of a doubt, help you off of the back of that. Okay, if you haven't got the book, that will give you a link to the website. But I'm sure if I put a link into the, if I put our website link into the chat right now, if you click on that and go to our homepage, book a call, then we can find out exactly what's wrong, where the challenges are, what issues you're having. And we'll call it a strategy call because we find out where you are versus where you want to be, and then connect the dots in order to be able to make sure that you can do it and give you a date at which you should be able to do it in the future once you've put whatever the problem is right.
Brilliant. Okay, good. And we'll take one or two more questions because we're just a bit up on time. When do you think we will see more mortgages coming to the market from lenders? Because obviously a lot of lenders pulled, didn't they? So that a lot of lenders pulled out of the market. Are you seeing more come to the market, or?
We are, yeah. It's very volatile at the moment. It seems to have, over the course of the last week, kind of calmed down a little bit. It's like anything. When there's fear and anxiety and worry, you know, the immediate thing is to retract absolutely everything to reduce risk. As things begin to settle, And recently, you know, the UK interest rates are dictated by the American swap rate. The swap rate actually came down a little bit over the course of the last few days. So that's reducing the volatility that we're currently seeing. And I think we'll start to see some stability depending on what happens with government and changes in interest, changes in policy, and all of this uncertainty that's going on at the moment. So, yeah, who knows?
Yeah, we're not sure, but definitely I think there will be more lenders, and I think that what I like about the current market is the way we're all connected globally and technology. There is alternative finance becoming available as well. You know, your non-traditional lenders coming to market that are going to be competing against the banks, right? So you've got these property platforms, and you've got, you know, I was speaking to a friend of mine. They run a crowdfunding platform. So, you know, they raise finance for developments, and in some cases they can offer attractive terms. So there's different ways to lend. There's bridging finance. You know, you just need to check what's going to be best suitable for you. But I'd certainly think the markets are progressing, and there will be different types of alternative lending coming to the market as well from my side. We'll do one more question. I think this one's for me. Do you think off-plan developers will reduce or increase deposit amounts required due to current markets? Now, I used to work on projects where, I mean, they used to ask for like 40-50%, but there's more regulation now, especially in case, you know, to protect investors really, in case there are troubles or developers run into trouble, that your money's protected, that your deposits are secured. So typically that require either 10 or 20%. We prefer not to go higher than sort of 25%, just to mitigate risk for investors. I do think not only are, you know, of course, because remember, developers also use funding, right? So they'll need to also factor in their interest and reevaluate their pricing strategy in some cases. So again, it'll be interesting to see what happens, but I don't think that the requirement for more money down would happen unless it's alternative assets, where they're looking at cash deals like completed stock or student accommodation. They might require more funding because they're ultimately using investors for funding rather than the institutional lending route or banks. So that's the answer to that. So I think, just to summarize, you know, the mortgage markets are moving. The pound's already slightly recovering. I know that Liz Truss is under the hammer as they do so, and that Kwasi Kwarteng seems to be out, so that, you know, they've thrown him under the bus. But yeah, it looks like Jeremy Hunt's in, and he's already installed a little bit more confidence by retracting on the higher income tax brackets reduction, which didn't quite make sense, and other things. But the benefit as well is stamp duty for first-time buyers. You know, that there's been changes there, so stamp duty tax is less aggressive. And also, I think they will be introducing things to counteract interest rates. So I do believe there will be, when the budget's announced, so the end of this month, I think there will be a lot of things to counteract the concerns in the markets and to create stability again. So hopefully they can come up with a better plan this time. We'll keep clients updated on our newsletters and blogs. So yeah, we just believe, look at potentially reassessing your portfolio and your mortgages. Look for recession-proof investments where your rent is covering your debt, cash flow positive. If you've got extra money right now, it could be a great time to buy. There's motivated sellers. There's better deals out in the market. So yeah, we still believe property is a great investment, and please do let us know. Drop in the Dropbox in the comment section if you want our latest UK market guide. If you just put in free guide, we'll send you the free UK property guide after the webinar. And then we've also got a latest guide on those particular projects: Manchester, Liverpool, Birmingham. So again, thanks, Gary, for joining us today. We've recorded the webinar, so anyone who's missed it, we'll send the webinar recording out as well. Have a great evening. Thanks for your time. And yeah, all the best. Thanks a lot, Gary.
Cheers, mate. My pleasure.
Cheers.
Thank you very much, everybody.
Awesome.
Hope you got value. If you need any help, obviously click the
Brilliant.
link in the chat. We'll be more than happy to have a conversation.
Thanks. Cheers. Thanks a lot.
Cheers, Dale.
Take
See you
care,
soon,
everyone.
mate.
Thanks. Bye-bye.